So if Powell told the truth and said, well, we can't, well, then the bonds would crash, mortgage rates would spike even more, and then we would have the recession, and we'd have the crash, not the soft landing. So Powell has to keep the markets believing that rates are going to go back down.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
Somebody asked Powell, how much confidence should the public have in your forecast? Now, the answer should have been, well, absolutely none. I have no clue what we're doing. We're just, throwing darts here, or, we're just putting a positive spin. But he kind of acknowledged that you shouldn't really have much confidence, because he said, look, they're highly uncertain. We're just making a forecast and we don't really know. And it's an understatement. They don't know, right? That's the point I would made at the beginning. They have no clue, but they have a bias in trying to present an optimistic forecast. And one of the reasons they do that is they are a big believer in expectations, just like they potentially believe that it's expectations that cause inflation. They also think that it's expectations that help the economy. If people think the economy is going to be good, well, then it's going to be good. It's kind of like the field of dreams, right? If you build them, it will come, right? If everybody believe, if we all just believe, right? If we could just close our eyes, I believe in a strong economy, I believe in low inflation, that we're going to collectively will these things into existence, because it will become a self-fulfilling prophecy. These guys actually believe this. And so, they want to say good things, hoping that they will actually create those good things by all of us having an optimistic perspective. Because if we're negative, right, if we think the economy is going to be bad, well, then it will be bad, according to these economists. Because if we think it's going to be bad, well, we're going to prepare. We're going to stop spending. We're going to build up our savings. We're going to hunker down, build up our rainy day fund. And so they think that the preparation for a recession is what causes the recession. So the Fed wants nobody prepared. And so when a recession hits, you're completely unprepared for it, and you've got no rainy day fund, right? They want us very vulnerable. It's better if people are prepared for a recession, because then it won't be as severe. You shall have a cushion. If you get completely surprised by the recession, and you're in a very vulnerable position. So what the Fed is actually doing is very counterproductive. Now, he did talk about cutting rates, that at some point, he said, well, at some point it will be appropriate to cut rates, right? Of course, because that's what the market wants to hear, because nobody can afford these rates. So like, when are you going to start cutting, right? When can you declare victory on inflation so you can cut rates? See, the reality is, even if the Fed was able to get inflation back down near 2%, which it's not, it can't just immediately cut rates down to low numbers again, because then inflation would shoot right back up. Not only do rates have to go high, but they have to stay high. And it's not even high. 5%, a 5.25% Fed funds rate is normal. It's a normal rate. I mean, other than the last 12 years, which have been completely abnormal, there's no reason for the Fed to be cutting rates unless, by its own, Keynesian playbook, unless we're in a big recession. So unless the Fed is going to say we're going to be in a recession, they shouldn't even be talking about cutting rates. If they have no recession in their forecast, if they think the economy is going to keep growing, they shouldn't even be talking about rate cuts. But they have to throw that bone to the markets, because the markets know that they need these rate cuts. So they have to keep hope alive, because if the bond market had to price in 5% rates, for the duration, the 30-year Treasury would crash, the 10-year would crash. Those yields are still barely above 4.3, 4.4, even though the short-term rates are 5.25, 5.5. That's because everybody expects that by next year, the Fed's going to be slashing rates again, even if we're not in a recession. So if Powell told the truth and said, well, we can't, well, then the bonds would crash, mortgage rates would spike even more, and then we would have the recession, and we'd have the crash, not the soft landing. So Powell has to keep the markets believing that rates are going to go back down. Well, the reality is that's not going to happen. And when the markets figure that out, that's when there's going to be a violent reaction. Now, they did talk about bond yields once. Somebody asked them. It only came up one time, right? Again, that's a big indication that the Fed's lost its inflation war because you got bond yields going up. And someone said, pointed it out, like they're the highest they've been in, I think since 2007. Yesterday, we hit the highest bond yields since 2007. And the reporter asked Powell, why is this happening? And the first thing he went out of his way to say is, well, it's not because of inflation, right? So if you're thinking that interest rates are rising because of inflation, well, we're going to tell you that's not why. Well, how does he know? How does he know why yields are rising? I mean, he kind of said he didn't know. Well, if he doesn't know, then how does he know it's not inflation? And in fact, what Powell goes out of his way to say is not causing bond yields to rise, you pretty much know that that's what's causing it. Because he doesn't want people to know what's causing it, so he wants them to rule out inflation. But inflation is what's causing it. More and more people are starting to expect higher inflation, and it's gradually being priced in to the long end of the yield curve. Now, we've barely begun. We have a long way to go, but the process has started. Now, what Powell said potentially could be causing rising bond yields was, number one, well, this super strong economy, right? We have a really strong economy, and so there's demand for credit, and so that's, pushing up rates. So, it's a good thing, right? It's, hey, yes, rates are rising, but they're rising for the right reason because it just reflects a strong economy, which is BS. Now, he did allude to the debt without actually saying it. What he said is that another possible explanation is the supply of treasuries. Well, duh, right? There's all these treasuries on the market. Where are they coming from, right? Why do we have a big supply? He didn't mention that because he doesn't want to talk about fiscal policy, but we have a big supply because the national debt is exploding. I just mentioned the national debt went up $1 trillion in 3 months. That's $1 trillion worth of treasuries that we had to sell during those 3 months. We had to convince people to buy them. And so we're having to pay higher interest rates to get the suckers to pony up. But that's not all the treasuries that we had to sell during that 3-month period, because we had all the maturing treasuries that were sold a year ago, 2 years ago, 5 years ago that happened to mature during those 3 months. And now we had to find new buyers for those, right? They had to be rolled over. And that is what is pushing up yields. But Powell doesn't want to talk about that because he's afraid to criticize the Biden administration for running these deficits. So, yeah, maybe it's got a little bit to do with supply. Yes, it's got everything to do with supply, but also that supply is indicative of future inflation. Because what the markets are sensing, and they will sense it more as we continue, is that, okay, the debts are very big. What does that mean? That means that even though the Fed is doing quantitative tightening now, the Fed is going to have to return to quantitative easing because it's going to have no political choice other than to monetize these debts. So bigger deficits today lead to more inflation tomorrow because the Fed has to create the inflation to buy the debt. And so the added supply of treasuries is a problem because it means higher future inflation. So for Powell to declare emphatically that the rise in bond yields has nothing to do with inflation is a lie. But again, he wants to say that because he wants to take credit for inflation going down. So he has to ignore all the signs that it's not going down, like rising oil prices, which he said have nothing to do with inflation, and rising bond yields, which he claims has nothing to do with inflation. Apparently, nothing has to do with inflation, right? Because the Fed doesn't want to be held responsible. And again, the Fed doesn't even think they cause inflation. They think the public causes it based on their actions. Oh, by the way, one of the reporters asked him about how these higher interest rates were hurting people that have a lot of credit card debt, right? That are living off their credit cards and they have all this debt. Nobody pointed out, though, what I've been pointing out is how these higher interest rates impact consumer prices, because businesses that also have debt, and they don't have 30-year fixed rate mortgages like a lot of homeowners did. A lot of businesses have short-term debt, and their debt service costs have risen sharply. And that's just another cost of production, cost of doing business, like labor costs, like raw material costs. And so they have to be passed on. If you buy a consumer good from a company and that company is paying interest on its debt, well, you're paying the interest on that debt because it's going to be built into the price of the goods that you're buying. And so nobody points out the irony of how the rate hikes are actually contributing to the price increases that we're seeing. But this one question was focused only on the lower income consumer who's struggling with a bunch of credit card debt. And the reporter's like, hey, these people are having to pay these higher interest rates. So aren't you hurting these people with your inflation fight? And Powell's answer was, well, we're not really hurting them because these are the people that are hurting the most from inflation because they have no savings. They spend all their money on food and energy. In fact, they spend more than they have. That's why they have all this credit card debt. And so he said that even though they're paying higher interest on credit card debt, they're ultimately going to be the biggest beneficiaries of bringing inflation back down to 2%, except that's not going to happen. What the Fed has done is not going to bring inflation back down to 2%. Inflation is going to keep on rising. And so these, poor people that are living off of debt are going to get no relief. They're going to get hit twice. They're going to get hit with higher inflation that the Fed is not going to restrain. And their too little, too late, quasi effort to fight inflation means they have to pay higher interest on the money they borrow to buy the goods and services they can no longer afford. So the people that he claims to be championing are the ones that are suffering the most from the inflation that the Fed has created and that the Fed is powerless to rein in due to the short-term political consequences that would befall everybody if the Fed actually did what it would take to fight inflation and force the government to make drastic cuts to government spending and get rid of the deficit and all those things that have to be done. Now, I also thought it was interesting that Powell admitted that the savings rate had dropped a lot. And he didn't even say that like it was a bad thing because he said, well, we had a big drop in the savings rate. We're not sure if that's sustainable. Yeah, because once the savings are gone, you can't drop below zero, right? Although maybe could it go negative? I guess if everybody is going into debt, then maybe the savings rate it could be negative. But Powell did not, question the apparent contradiction there between how strong he claims the economy is. We got this super strong economy, yet he admits that the savings rate had fallen sharply. Now, if the economy is so strong, why are the workers in this strong economy being forced to deplete their savings? If the economy is strong, they should be adding to their savings. Again, when times are good, you save more. It's when times are bad that you have to fall back on your savings. So if you're talking about a plunge in the savings rate and you're also talking about a booming economy, some kind of bell should go off that, hey, these things are inconsistent with one another. Again, when you are doing good, right, you pay off debt. Again, it's that analogy that I've used many times, and it's a good one. That's why Jeff Gunlock uses it as well. You run into your old buddy that you haven't seen for a long time, college buddy, and you ask the guy, hey, how you doing? And the guy says, oh, I've maxed out all my credit cards. I've taken out a third mortgage on my house. I've depleted my savings. I'm taking on all this debt, right? That guy's not doing great. If you said I'm doing great, I got all this debt, right? It wouldn't make any sense. If another friend told you, he said, hey, how you doing? Oh, I paid off my mortgage. I fully funded my kid's retirement account or my kid's college fund. I've fully funded my retirement. I'm completely debt-free, right? That's the guy that's doing good, not the guy that's leveraged up to the hilt. He's borrowing all this money because that's the only way he can survive. When you have a strong economy, that generates surpluses, and now people can build up their net worth. I thought it was also interesting that Powell commented later on about, and this is like the last thing he said right before the press conference was over. He said that there is a significant improvement that he's seeing in household balance sheets. He said lots of good things are happening with household balance sheets. Like what? What good things are happening? If the savings rate is crashing, that's part of a household balance sheet. If your debt services are rising, that is hurting your balance sheet. I mean, what else do consumers have on their balance sheet? Their homes. Real estate prices have stopped kind of going up, but the cost of maintaining those houses has gone way up. Stock prices have started to come down. I mean, they had gone up, but they've been going sideways. So I don't know what he's looking at. He's talking about these strong balance sheets. The balance sheets aren't strong at all. That's just another thing that Powell got wrong.